I've consciously waited for 5 minutes. It's almost 2:05. So although people are still coming, I'll not make the people here wait any longer, and let's get started. My name is Jazz. I'm from Bullseye Capital Buyers Agents, and what we do is we build sustainable property portfolios. So what I mean by sustainable is properties that are relatively easier to hold on to. And when I say easier to hold on to, this actually changes from family to family. In my experience of working with investors for the last 2 years, what I realized is that there are families who may be earning $180,000 a year and may be saving approximately $60,000 a year per year as their savings. And there are also other families who are earning the same amount of money, have the same family structure, number of kids, but just because of a different lifestyle, they may be saving $100,000 or $110,000. So the sustainability factor or the criteria for sustenance changes for both these families because both are saving a different number at the end of each year. And that is why the same logic or the same strategy does not or cannot be implemented for all the families. So welcome to Bullseye Capital, where we try to build sustainable property portfolios. That's an introduction about me. That's how I looked approximately 10 years ago. I'm actually a mechanical engineer from Government College of Engineering, Pune in India. All those who are from India might know about it. Come on this side, please. Please get seated. I worked in Tata Motors business planning, where my core job was forecasting and business case analysis, where I had to basically predict the future in the complex automobile Indian market. Being a part of Tata Motors, I was lucky to be sent to Indian Institute of Management, Ahmedabad, which is, for those who are from Australia, which is the rank the 51st in the Financial Times 23 edition. And I also work very closely with McKinsey Consulting. Why am I sharing this background is because I bring those learnings from that complex automobile Indian market into the real estate market of Australia, which is relatively simpler. I migrated in August 2016. I'm family oriented, father of one for now. There's a debate in progress with my better half. So after migrating in August 2016, I bought my first property in 2018 after struggling to find a permanent job for 2 years. And then when I moved into that property, I realized I made some mistakes in that property, and I tried to learn from my mistakes, and that is when I realized that property investment is actually a very good tool in Australia as an investment tool. So after that, I presented to my wife that if for the next 2-3 years or 4 years we invest systematically into property, probably in 5 years' time we will be in a much better situation than we are now, and in 10 years we'll be doing better. It was something similar to the kind of presentation that I used to do to my bosses in Tata Motors and other automobile companies. She said, okay, let's do this, let's invest systematically for the next 2-3 years. And that is how I built a property portfolio of my own. In a short span of around 5 years, I built a property portfolio of 6. And now I am using those learnings which I had which I learned from my own property portfolio to help my clients build a property portfolio. And that is how Bullseye Capital came into existence. So what I do is I monitor property markets pan Australia. There is continuous research and data analysis done. I have purchased over 60 plus properties in 5 states in the last 1.75 years that Bullseye Capital has been in existence for. I am working on the 6th state and I have 60 plus Google reviews. One very important part that Bullseye Capital does is customization, where we have to change the strategy for each client, for each family. That is also not because other different families earn differently, but also because they may have different taste, they may have different future plans. There may be families who may be planning kids in the future, which adds on to the expenses possible, and there may be families who are not planning to have kids in the future and are done with those. So that's where customization plays an important role in what is the future plan of the family and what properties that they can hold on to easily. The core values of my organization is our interest line, your interest. This is a tagline that is there for my company. And one of my most key performance indicators is repeat business, which I will share some light on when we come to that point. So when I say let's build sustainable property portfolios, let's just look at the word property portfolio. So property portfolio, is it important to build a property portfolio? It's probably a safer way to invest. So rather than picking up big chunks of money or big ticket items and putting a lot of money into one property. Our proposal is to go at slightly lower end, cost-wise properties around the $400,000-$500,000 mark, and by that you can add to a significant number of properties, right? So that is what is meant by portfolio, okay? Where you're not buying one 7-figure item as an investment property, but going for something around the $500,000 mark. It helps in the risk management strategy because as a management approach, you're not putting all your savings or your whole capacity into just one property, but you're diversifying it. And that's where I mean that smaller amounts to be invested across multiple properties. And when it comes to investing and buying, is it important that it should be sustainable? Of course it is. So how can it be sustainable? If you concentrate on the purchase price that you're buying it at, where you don't end up buying at a very high cost. 2, if it is easy to hold on to. Now when it will be easy to hold on to when your rents are at optimal level as compared to your outgoings, right? And this sustainability is different for each family. Like I said earlier, different families, although maybe earning the same, could be saving differently. There are seats in the front if you want to come and sit. Please come, thank you. And the last point is, should it be diversified? So when you are buying in, around that $400,000-$500,000 point, that is where you can, go and pick up one in each state and take the benefits of each state and thus diversify across multiple states. In the slides to come, you will see how we have done it for some of our clients. So when you are building a property portfolio, there are various strategies that you can use for building a property portfolio. These are some of those. Okay? We generally recommend that the first property you go for should be for capital growth, and the second one also should be for capital growth. It is important to not only concentrate on capital growth, but the capital growth should be consistent. It should not be the capital growth that comes only for 1 year. It should be for a longer period of time. Now, once you have bought for first 2 properties, of course, your loan limit will have reduced, and that is when you have to slowly start concentrating on the higher rental towards when you're coming towards your serviceability limit. Then for the 4th one, we propose that people should consider a development potential, where you can pick up that whatever you have purchased and subdivide it or develop something on the rear like a granny flat, like it is done in NSW. Another strategy is about renovations, where you can put in a cosmetic reno of $10,000 or $20,000 or something like that and get a significant uplift. And then for some of those, there are possibilities of commercial properties or properties which are residential with a commercial potential, where you can get approvals to have a mixed usage of residences as well as offices or some kind of shops. So let us look at some of the best examples across all of these strategies. And it is not necessary that you have to go or you need to go in this particular order. Based on the basis of family situation, we may recommend somebody to go for a different strategy or sequence of this to be done. So here is an example of our best capital growth, and this is a property that was purchased in Victoria, and it was advertised for $390,000 to $420,000. There were 13 offers on the property. Our first offer from us was at $390,000, but then we had to go up significantly, so we went up to $476.5. After the first year, the investor got a valuation of $634,000, which was probably around 33% in the first year. It slightly dipped, and then now it has started growing again. So what is the most important thing out here is that this was purchased in Victoria at a time when the news or the media was speaking about other places. So the beauty of the Australian real estate is that there is growth happening in a lot of places. You just need to know where it is happening. And the most important thing out here is that it is important to know about what is the true value of the property. So although this property was advertised around $390,000 to $420,000 at that point of time, we had a feeling that its true value at that time was around the high 4s or just around shy of $500,000. And that's why, although when we were buying this at around $86,000 more than advertised price, we knew that we were buying it probably at the right price till the time we were under $500,000. So that's how you need to know, or that is the important point or the important takeaway from the slide, that we should know the true value of a property.
A question on that.
I'm sorry.
Sorry. Okay.
Let me please continue this. We will have a session for that because there's a school of thought.
Okay,
If
sure.
I start, I'm sorry, with all due respect, if I
Alright.
start taking it, then I'll have more. So let me continue it smoothly. I will ask all questions. Sure. This is another example of consistent growth where this was purchased at $409,000 and it grew by 59% in 3 years. So that comes down to approximately 20% per year for the first 3 years, right? Of course, it has some subdivision potential, which is subject to council approval, and the investor has been able to pull out equity to fund 3 properties from this one alone. This is an example of best rental yield, where this property was purchased at $245,000. It's currently tenanted at $560 per week. So with that, this property gives a rental yield of around 11.8%. So under normal calculations, if this property has to be a negative cash flow property, the interest rates has to be anywhere between 9.5 to 10%, where it's not going to be, right? And rental yield is not the only intention of buying property, it has to be capital growth also. So the capital growth on this property has been 12% in the first year, and that is where I'm also mentioning that. It is a good combination of rental yield as well as capital growth.
What's the location of
Let me please come on that. Sorry guys, let the questions be for the later please. Right? This is another example of one of the best examples of what we bought, development potential. Okay, now if you look at this property, this is actually made out of, it's not brick, so definitely it's a very old property, it's probably 1940s built. But this gentleman wanted something which has some development potential. So this was purchased at $400,000, it's tenanted at $380 per week. What we could see is a growth of around 14% in 7 months and has subdivision potential. So when it comes to buying property, many people look at the looks of the property, but there are instances like this where the potential of the property is there from development potential, and that is when the looks do not matter as much. And the location and what is the future scope takes more importance. Cool. This property was purchased for a gentleman who already had 4 to 5 properties in his investment property portfolio. So I had to buy, he gave me a requirement that he had to buy something which has some renovation potential. So we bought him this property for around $310,000, and the land size was 900 plus square meter. It's tenanted at $400 per week. He spent around $10,000 in renovation, where he changed the carpet, he did an internal paint job. It actually came to around $8,000. I just rounded off to $10,000, and he got an uplift of around $30,000 to $40,000. So that is what a small renovation does. It gives you an instantaneous jump in equity, and then of course you get the growth of whatever capital growth that location is getting. This is an example of a commercial potential property that we bought for one of our clients. We bought this. This is tenanted at $960 per week. These are actually 4 small units. So if you can see, this can be used for commercial applications with approvals, of course. And the interesting fact is that before it went to auction, we had actually given a pre-auction offer of $600,000, but the owner rejected it and said go to auction. And our client was lucky to buy this at around $19,000 lesser than what we are offering. So we bought it at $580,000 plus. So these were some of the examples of those 6 various strategies that we have implemented for our various clients. So when it comes to bullseye performance in building property portfolios, our repeat business till December 2022, approximately more than 50% clients bought more than one property within 12 months of first purchase. When it came to January 23 alone, 75% of our purchases were for repeat clients. In February 23, 66% of our purchases were for repeat clients. Maximum number of purchases in first year by same clients are 3 properties. There are 3 such clients, and 2 of them are speaking of the 4th property. Purchasing speed is also an important parameter that we look at. Sometimes we have purchased within 1 week for multiple clients who have some personal urgencies or pre-approval timelines, where the pre-approval is coming to an end. And why we are able to do that? That is because we have the advantages of buying at multiple locations across multiple states at the same time. While we are buying in 5 different states, and in one of those states we have purchased in 6 different locations. So we get a lot of options to present to our client. I have a small team of 3. My team does the admin work, and core activity of the property buying is with me, because that is the main value addition in the whole process, which I keep it with myself. We have till today built property portfolios for around 15 people, but we will look at the story of around 10 clients who built property portfolios with us. And here is the story of one client. So this client bought 3 properties with us in 1 year. The first one that we bought for him was tuned to the client scenario. So before he came to me, this client had already bought an investment property which was not having a very good rental yield. And because of that, it was having a detrimental effect on his loan capacity. So the plan was to try and optimize his loan capacity. So I worked very closely with this broker and bought his first property in Queensland, which was tuned to client scenario. When I mean tuned to client scenario, that means that we had reverse calculated what kind of rental yield we want for his property. Once this was in September 2021, then we are expecting him to come back in a year, but he came back in around 6 months in March 2022. And now, since his previous cash flow issue was sorted, we were able to concentrate on capital growth, and we went and bought for him his second property in NSW. After that, he came back for his third property in August 2022, and I bought him a development potential property in South Australia, where, of course, with subject to council approval, he will be able to build more units at the back of this house. So this is the story of another client where he bought 2 properties in 1 year. And the unique part, every client is different. Every client has a different taste. So this gentleman had a different taste, that he wanted to buy all his properties in Victoria, no matter how much I used to convince him to move out of Victoria. So I say that he is in love with Victoria. We bought his first property in Victoria. He got a growth of around 25% in the first year. Also, this was positive cash flow in those days. He also got some tax deduction. And then we also bought his second property in Victoria, which was an off-market purchase, and he's also got a 20% growth. He did sign up for his third property, but then there was an accidental pregnancy, so he had put things on hold, and I'm happy with with his new addition in his family. This is a gentleman from Sydney, and he had come down to me with a budget of around $800,000 with a plan to buy one property, where I proposed to him that let's buy at smaller chunks at around $380,000, $400,000, and he agreed to run with that strategy. So we bought this first property in Victoria, which was an off-market purchase, positive cash flow. He saw the growth in 6 months, and then we bought his second property in Queensland, which is a 900 plus square meter land. It's a duplex. In those days, that time it was tenanted at 515 per week. We were able to negotiate it well, and he saw a decent amount of growth in that too. This is one of the clients who has bought 3 properties in 1 year. He's now speaking about the fourth property. He will be my trump card in the sense the maximum number of purchases. His first property was purchased in Queensland, which was for the intention of cash flow and tax savings. Then in a few months he came back, we bought his second property in NSW, which was with the intention of capital growth. And then we bought his third property in South Australia, which is subdividable. Of course, it is subject to council approval, and close by properties of a similar land size are already subdivided. So this is another story. Here's another gentleman. He purchased 2 properties in 6 months with us. His first property was purchased in Queensland. He got a 14% growth in 6 months, which was bank valued. Then after a few months, he came down for a second one, and we bought in NSW. It was purchased off market, and we are expecting a growth of around 18% in the first year. That also gave him some tax savings. This is the story of another gentleman who purchased 2 properties in 6 months. First one in NSW, got a strong capital growth of approximately 9% in 6 months. And then his second one in Queensland, which was purchased off market and then was also tenanted off market. So there are pockets where you're able to get tenants into the property without even advertising it, because there's in some places there's actually a waiting list where tenants are looking for properties, and there's a waiting list at the rental management office. This is a client from Sydney. They are this couple is rent vesting. So they are renting out here in Sydney, and they bought 2 properties in 6 months. Their first one was in NSW with a strong capital growth. And this is where I went for a directly subdividable kind of a property for them for South Australia, where it's a huge land size. So this is actually a 1300 square meter land size, and with the subject to council approval, they may be able to build 3 on this. There are close by plots. If you see the photograph out here, there are some plots of similar land size that have already got 3 built on them. Another client from Sydney, they built 2 properties, purchased 2 properties with us in 6 months. The first one was in Queensland, and this is a 2005 build. He got some tax savings on that and a good cash flow. And then we purchased the second one in NSW, which is a land size of 650 plus square meter corner plot, and rental appraisal is at around 380. Some of the advantages of corner plots, as many of you know, you may be able to build at the back or break down the existing house, and there's more ease, or it's more easy to get the approvals to build 2 units or 2 townhouses on top of it. Same client, 2 purchases in 4 months. The first one is one of the most competitive markets in Australia at the moment. We were able to purchase this at $390,000 and was built in 2014. And then after a few months, we bought a second property in Queensland. It was purchased at $330 and tenanted at $420 per week, built in 2010. And if you may note, what's unique about this gentleman is that he likes only recently built properties. You know, he does not like much older properties. And even though the budget is tight at around $390,000 or $330,000, we are able to build him something recently built. Another client, 3 purchases in 5 months. He's now speaking about his 4th in few months from now, because he's bought 3 in the last 5 months. So his first property was purchased in January in Queensland. This was purchased at $335,000, which is a rental appraisal of $480 per week. The second in NSW at $425,000. It was very interesting to see that there was a bed and office in the same room. Probably that's where he has his afternoon siesta. And the third one in South Australia, which was recently purchased in his SMSF. So if I may ask, what did you note in the last 10 slides? And if I have to answer that, what we have been able to do is, keeping that budget around that, under the $500,000, we have managed to deliver to the taste of different clients. Some clients like only Victoria, some clients like young, recently constructed properties or not too old properties. Some clients are looking for development potential, some clients are looking for renovation potential, so on and so forth. So these are some of my key learnings. When it comes to building a property portfolio, please make a systematic investment plan which is customized to your individual scenario. So it's not necessary that you have to buy 1 in a year or 1 every 6 months. Find out what is your comfort zone, whether you would like to buy once in 2 years or how would you like it to be. Your first 2 to 3 properties should be spot on or your trump cards. So it should be focusing majorly on capital growth, because capital growth is actually one of the most significant outputs or the intentions of investment. Rental yield is something which is a side dish. Then once you have built those first 2 or 3 on capital growth, then slowly think about higher rental yield, which may be something like multi-dwelling or duplex kind of a scenario. Then you can start thinking about small cosmetic renovations. You can start thinking about subdivision projects, etc. Please do your research via data points, which are important: vacancy rate, supply and demand ratios, etc. Property investing is more about macroeconomics, like is the economy diverse or is it solely dependent on only one kind of industry? What is the affordability or paying potential of the people who are buying properties out there? What is the lifestyle or taste or preference for the type of house for the people who are living out there, and not what is your kind of taste for what you want to buy? What is the kind of job creation that is happening out there? What are the upcoming industries, infrastructure spend happening, whether the feasibility is done, whether it has been started or it is nearing completion. Other key learnings include local knowledge is important, but macroeconomics has much higher influence on capital growth. Continuous growth over 5 to 6 years is what the intention should be. Whoever is your mentor should have a proven track record. This is a very, very important point. There are so many variable factors that come when you're analyzing properties or where to buy, that many people trying to do over analysis, which leads to too much information, confusion, or analysis paralysis is what I call it. There's always a dilemma between cash flow and capital growth. And it's more important about understanding what is the priority at that point of time. Do not put all your eggs in one basket. Keep your continue buying in different pockets, probably in different states, with a different strategy. Every time you buy, you should have a different strategy that you put into place. Bullseye endeavors to buy the right property at the right price, at the right time, with the right specs, such that at the time of selling, it will attract the right buyer who will pay the right price for it. And that is something you are also probably wanting to do. So that brings me to the end of this presentation. And now if you want, I can take some questions. Yes, please.
What are the factors that you should consider to find a capital growth property?
Right, so you should have to look at factors like what is the kind of future growth out there, what is the vacancy rate, what is the demand scenario, what kind of job creations are happening out there, so on and so forth. So there are multiple factors, but these are the 3 or 4 top ones that I look at. Yes, sir, please.
How do you source your properties? How do you find these properties? Have you got people on ground in all the 5 states, or do you have your own?
Yes, so we have people out there in 5 states, and it is also about our repeat business with the real estate agents. So because we are buying with those same agents again and again, there's a relationship, there's a trust factor, because of which we come to know about properties which are coming to the market, sometimes pre-market or off-markets. So because of that repeat business, there's a continuous relationship happening out there, and that is one of our key value additions of sourcing properties. So we get to know information to some extent in advance, as compared to the normal person.
What is off-market property?
Off-market property is a property which is still not advertised. So in certain states, the real estate agent may get his authority to start selling a property, but he cannot advertise it till the time a particular property has not completed a certain amount of time. And that is when we can get that earlier information, which is called as an off-market property.
Okay, so like I have heard this most of the times, like buyers agents say, okay, we had made this deal while like we secured this off-market property, but why any seller would sell that? Like if like everyone knows that my property has this value, so why he will sell that off-market? Okay, I am happy in getting 20k less because I am selling it off-market.
So, but buying off-market does not always mean you're getting it at 20k less. So there may be different scenarios. There may be an urgency at the seller's end that he would like to get the deal closed as soon as possible. Maybe he is buying something else somewhere else, right? And he would like to get that deal done as soon as possible. So there are also some sellers who, when the interest rates goes up, it is not only the buyers who get a bit scared. It is also the sellers who are probably reading the news and feel probably this is not the right time to sell. So there are some sellers who don't want to go through that expense of a marketing and a staging where they put all that good furniture, good looking furniture inside the house which is smaller in size, etc. They don't want to go through all that expense. So there are times when the real estate agent says that we'll not do that expense, we'll try to sell it off market itself without that expense. If you get the price that you desire, you sell it. Otherwise you don't sell it and you can wait. Hold on. So there are some, this is I'm just taking a wild guess. Okay? So I can't get into the shoes of the seller and understand under what circumstances is he selling. Is he having something else that he wants to buy, or we can't guess that. But buying an off-market property does not necessarily mean that you're buying it at under market value. These are two different things. You could buy a property which is advertised and is still an under market property. So it is it's two different things. It may happen, it may not happen.
So you talked about SMSF properties. So is there some kind of assistance that you provide for those?
Or not. So that was just one gentleman who bought his third property with us in the SMSF structure.
Okay.
So that is nothing that I do about how to structure it up. That's an accountant and his broker who sit and do that, and I have none of those.
Yeah.
But there's no validation that I do it. I just mentioned that we bought it in his SMSF.
With your team, do you have people locally in the area?
Yes,
Do you have
yes.
someone in, say, Western Australia? Or
Yes, so wherever we buy, we have people working out there with whom
Okay.
we leverage our relationship with those people to get that local knowledge.
Yeah, so can physically go and see the property?
Yes, of course.
Okay.
Yes, boss. Tell me. Sorry, I stopped you that time. My sincere.
So my question is about that property. So it was advertised 390 to 420. You placed offer 390 and ended up buying for 75K. So generally, one of the sales points of buyers agencies buying a property at below market rate and getting a equity instantly and then capital growth and all. So when that's how we always hear. In that example, that was a big jump from an initial offer to the purchase price. How did the buyer react? And as a buyer, how do I, if you are my buyer's agent, how do I, what, maybe you can walk us through that journey, like what made that buyer to trust you and going such a high jump on the purchase price, as well as was it underpriced just to get the buyer's attraction? So those, can you walk us through?
So, first of all, you have asked me a very difficult question. Let me try my best to answer it. How did the buyer build that trust? We helped him look at the recent sales to understand that that property which was advertised at 390K to 420K was actually worth much more. But it was advertised as per the legal norms that they have to look at the recent. They can pick up any 3 sales of that similar number of bedrooms and say these 3 sales are at this range, so we are advertising at this range. So that is within the limitations. That is how they probably advertised it. I'm not sure about what rules they followed, but that is probably how they advertised it. And that is also one reason why, because of which they got a lot of buyers who came out there, right? 13 offers in the property, you can assume how many people looked at it. Must have been more than 20-25 people, right? But the land size, the number of bedrooms, the construction type, the proximity to the important points out there, all the location importance was such that all the houses out there close by were selling at a decent price, which was still not updated in a lot of online forums. But since we were buying out there, we knew that okay, boss, 1 week ago that property sold at so much, that property sold at so much. So this buyer was able to see that yes, this has been advertised at probably lesser, and yes, although we are buying at 476.5, we're probably buying at 500, at some thousands of dollars lesser than what we estimated its value to be around 490 or 500. So I had to show him that data, and it was also his experience with the journey in us when we lost out on a few properties, where we knew that we had paid, we were offering more than what was being asked, but somebody else was offering even higher than us, and it was not a small amount. So he was understanding that the market is moving fast, and this happens quite a lot of time. The market is moving much faster in the real world, but the online data takes time to catch up. The online data sometimes runs a month or 2 months behind, and that's why this instant something may sell in the market for suppose $300,000, and then that data to reflect in time will probably take a month or 2 months for it to be reflected. So there's always that gap between the real world scenario or this instant live status as compared to what is online.
Is this a capital city or a regional?
Yeah. Those numbers, if you see $400,000, you don't get anything in capital cities, sir. You will not get even a small one room by it.
What are your charges?
We'll talk to you about that. We'll get in touch with you. Sorry, sir, that gentleman asked.
The 10 slides you ran for different people.
Yes.
Most of them showing like if it's rental return, you're talking about South Australia or Queensland and all that. And when it comes to capital growth, most of those portfolios of purchases are in New South Wales. So does that mean if one following capital growth, you need to stay within New South Wales, or there are pockets within New South Wales where you can get a rental return as well?
Very well observed. Very well observed. Okay, so every state has certain pockets where you can get very good capital growth, and certain within those pockets you will have 1 or 2 such properties which will give very good rental yield, right? So generally, whenever you go for multi-dwelling, or within one block of land you have a duplex, there are 2 families you can live, or you have something like a granny flat, etc. Or there are also, if you remember the last slide, there were 4 properties, 4 blocks of units, right? So that is where you can show that you'll get a good rental yield, right? So in every state, there are pockets where you'll get good capital growth and good cash flow, but there will be separate pockets or separate properties such. And yes, most of our purchases in NSW have been with the intention of capital growth. Most of our purchases in Queensland have been with the intention of
Is it
better. The cash flow is better because if you see the rental returns in Queensland is higher than what it is in NSW.
Is
but
it
very
possible
well.
to buy something within New South Wales as a positive cash flow or not?
This is a very difficult answer because it can change with every property to property, and this can also change by how much deposit you're putting. Right? If you're putting 10% deposit, it may not be, but if you put 20%, it may not be. So there is a possibility, and there are too many factors. How much deposit you're putting, what is the rental yield, etc., etc. Right? So that I can't give a clear answer on it. You have to look at each property and do the math on each property and then you look. Okay? But yes, the possibility NSW, my clarity is there that NSW is more capital growth, and its rental yield may be slightly lesser than other states, but it depends on what you want capital growth. So that's why I say that one property you should look from the intention of cash flow, other property can look at the intention of capital growth. That's how you're diversifying. So that later on, whenever you need to sell, you know that this property is ticking this box, but it does not tick this box. So this is what I can sell off. So on and so forth. Cool, sir. You were saying something.
I'm about to ask regarding the rent based. Like, is it a good strategy to build up property portfolio so you instead of investing? Basically, I'm from
It depends on family to family. Okay, it depends on what is the client's priority in life. There may be families who can't afford the property that they're living in, right? Where did they go? Where did they go? Here. Okay. This family is from city. Young couple. So they are not able to buy something what they want to buy out here because it's going to be $1 million plus. And they're not going to get that loan. But they were getting a loan of something like around $500,000-$600,000 for the first property. So that's why when we bought the first property for something in the low 400s, $425,000, I think, if I'm not wrong. And then over a period of time, when they came back, then we bought their second property also under $400,000. Right? So they had money, they had savings, which was sitting in their bank, which was probably not doing anything. So they used that money and have invested into 2 properties, which are giving some rental return, which to some extent helps in your loan serviceability, and the capital growth will also help in the loan serviceability. How much it will, that the broker will say. I repeat, I'm not a broker, right? But is that helping them use their savings in a better way? Because there is continuously capital growth happening out there, and of course that rental return is helping them increase their loan serviceability. Yes, boss.
Between this capital growth properties as well as the other set is positive cash flow, high rental yield properties. So when you talk about that high rental yield properties, what happens to the capital, say when you look at a 5-year or 10-year timeline, if you invest in a high rental yield property, will they still have any capital growth? How does the property journey with those kind of properties?
Okay, this varies from property to property. Okay, generally there used to be a general thought process that properties with high rental yields do not have capital growth or have lesser capital growth, which may be true in some cases, which may not be true in all cases. So it depends on the location. Okay, and there are certain locations where high rental yield properties like duplexes. Sometimes investors like duplexes so much that we have duplexes selling much more than advertised price, and that also drives growth. So it is. There's a beauty about Australia, and that is about for the next 2-3 years the amount of migration that the government is planning, right? The supply of houses or the construction of houses is nowhere close to meet that demand, right? And that may be because of number of factors. If you see the number of building up, those are also probably going down, right? Plus also cost of construction may be higher at this point of time, right? So is there a possibility that existing houses are getting that extra demand from people who wanted to build new houses? Possibly. And is that possibly going to be continuing on for the next 2-3 years? Because migration is supposed to clear off the backlog of 2020, 2021, COVID times, right? That backlog has to still be filled in, right? So there's a possibility. So for that, I can say for the next 2-3 years at least, we have some positive outlook. Apart from the high rising interest rates, the high inflation, apart from those pain points, there's some good silver lining also to it.
Okay. So when a client starts property journey with you, for the properties that you have them to buy, would you also be monitoring those properties and giving them recommendations like should they continue to keep it or is it time to exit, that kind of thing?
So we are in touch with our clients and we keep talking to them about their existing properties also. And sometimes they come up with some questions about the property that they may have bought with us. If you look at my presentation or where you see, when I am buying for those clients, it's not only about that one transaction, it's about the relationship, which is an ongoing relationship. And that's why you'll see more than 50% of my clients buy again.
Yeah, that's about buying and talking about exit strategy. I will also explain the exit.
When they don't talk to us about it.
Yeah. Sure.
Yes, boss.
So it seems like last 2 years the capital growth and project rental yield can be more because interest rate was low. What do you think about now next 2-3 years? Because if like, for example, if we kind of forecast this growth for next 2 years from now, what is your opinion where they will go? Because before I know like some property in regional area, they don't grow that much during that time when interest rate was like 3.5 or around 4%. So like what is your advice to your client from now to say whatever next 4-5 years?
Very tricky question. There is, I don't mean that in a negative manner. What I mean to say is, it is impossible to put a number. What will be the growth pattern in the future? What can be spoken about is, what are the positives, what are the negatives? What are the negatives today is that high interest rate, high inflation, a fear of a recession coming, right? Some negative sentiment in the market, that this is not the right time to buy. Okay, this is the negative factors influencing property purchases. What are the positives? Like I told you, 1, migration. 2, we were not able to bring in students, foreign students during COVID lockdowns. Now we are. Tourism is running at a high, right? Unemployment is least, right? The government is trying to push industries into specific segments, non-capital places, so that they are able to, reduce the stress, population stress on Sydney, Melbourne, other capital cities. So there are some positive factors, there are some negative factors. We have to see, only time will tell which will outweigh. But today if you look at it, how much is the demand in the market and how many are the properties coming to sell? And the effects of the new home construction expensiveness or the fear that construction companies are not doing too well, right? That fear causing excessive pressure on existing properties, and over a period of time, what will outweigh the other? That is how property market will go. But if you look at the last 30-year graph of how interest rates went and how did the property purchase price, median property purchase price in Australia move, you'll see that although interest rate rises were happening, property purchases prices in certain pockets, I repeat, in certain pockets, still grows. Okay? So even the last 14-15 months, we have had a price increase. Interest rate has more than doubled, right? We have had whatever 11 or 12 or 14 interest rate rises. But certain pockets, the growth is still happening. In certain pockets, it may have saturated. In certain pockets, so that is very, very specific to where you are bought, and not only where you are bought, what you have bought. Because whatever you have bought in that location, that property, that type of property should also be in demand. If you have bought a property or something like a 2-bedroom in a place where everybody wants only 3-bedroom, and there's nobody who's wanting a 2-bedroom, then probably, although that place may grow significantly, probably that property may not, because at the end of the day, it is also about the demand that the people are looking for in that location. If there's a demand that your property ticks marks those must-haves for those people who are looking out there. So I don't know if I've answered your question, but like I said, there's no clear picture. Okay, it's only about looking at the factors which are positive, which are negative, and time will tell which will outweigh each other. But historically, you can look at what has happened to the Australian. If you Google it up, Australian median price house median price over the last 30 years, you will see the interest rate graph going like that, and you know how the property median price value is. Some within, it also gives you information of some cities that doubled also, tripled also over a short period of time. But I will request you to go and do a little bit of Google searching on it. Cool. Thank you for coming. Thank you for staying back. Half the room is empty now. But thank you for coming, and thank you for being a wonderful audience.